got Matt Orton with us. He's Head of Advisory Solutions and Market Strategy, Chief Market Strategist at Raymond James Investment Management. Matt, great to have you back on the show. We love chatting with you here. And just, want to get your sense before the non-farm payroll data, if that's going to be the next big indicator that global markets need to watch out for, especially U.S. markets.
Hey, good morning, Tamana. Always great to join. And I think it's going to be a catalyst, but it's not going to be the catalyst like the next CPI report and PCE report is going to be, because I think we're cognizant that the economy is doing well. The jobs market is holding up unless it's a significant surprise either to the upside or the downside. I don't think it's going to ultimately inject too much volatility into the market. What investors in the US are really paying attention to right now is inflation and what direction inflation is really going to go. So perhaps looking at kind of wage growth and wage inflation within the jobless report will be important. But really it's, are we seeing earnings for the AI trade continue to hold up? I would argue that we are. If anything, the earnings that are coming in that have missed a little bit really on the guidance side are a result of constraints, not having enough of the inputs that they need, which I think further exemplifies the fact that this AI trade, especially the picks and shovels, is still here to stay. And then also, how are investors going to deal with rates? Can the economy continue to deal with higher rates? I also think it can. So I continue to tell clients to really use any meaningful downside opportunistically. And so I've been looking at a lot of the early infrastructure plays, the build out of data center companies that have fallen 15, 20, 30% over the last week. Those are looking very interesting to me, and a lot of them are reporting earnings over the next few weeks.
Matt, I find what you're saying very interesting in the context of Amazon reporting numbers overnight, and the fact that it got beaten down in extended trade. And it wasn't, at least optically from my perspective, and obviously it's very far, and I don't have as close a view on it as you do, but it wasn't a very large miss on the cloud computing side, right? And it got beaten down quite heavily. Do you think that that's going to play out? Because that exactly is what is happening here in this market, where earnings misses, even very small misses, are beaten down very dramatically.
Yeah, that's a great question, Neeraj. And I think when you really dig into what Amazon said during its earnings, earnings with respect to its cloud computing segment were pretty good. Its consumer segment did incredibly well. What the miss was catalyzed by was a lack of ability to have enough data centers and enough power. And what that says to me is when they are able to get enough of those supplies, and they will over the next couple of years because there's tons of investment coming in, that opens up a lot of different opportunities. So I think Amazon continues to be interesting. But where, again, I really would be wanting to put my money on any sort of miss comes to all of the infrastructure plays that are going to allow Amazon to actually get the capacity that it needs. I think that's a little bit different than India, where a lot of the concerns are more based around the economy, what earnings misses are signaling about the economy, and hence a rate cut, giving a little bit of relief or at least optimism to investors. That might be the catalyst that we need to both get foreign investors a little bit more excited, but also see domestic investors give companies a little bit of slack because earnings haven't been that bad overall.
Okay, Matt, good morning. And just one quick follow-up to that question, or broadly to the thesis currently. I mean, when I looked at all the global websites today, the Reserve Bank of India's decision was top of mind for everybody, which just shows that central banking conversations are up and about. Now, if the Fed, in its wisdom, were to stay on the pause mode, BOJ is an exception because they're coming up from zero, but if the Fed were to stay on the pause mode while the rest of the central banks bring down their rates, the BOE also sounded very dovish, by the way, is that constructive for EM flows, you reckon? Or the Fed needs to move for the incremental dollar to move from the US markets or the US fixed income to the emerging markets?
Yeah, and that nuance is really important because if the Fed doesn't cut, or there isn't the expectation that the Fed is going to cut, the dollar is going to remain strong. And a stronger dollar is a turnoff for emerging market flows. That's been a big, big challenge for investors overseas. And you're even hearing about negative FX impacts to a lot of big multinational companies in the US that are giving their guidance for the upcoming quarter and the upcoming year. So hopefully the signal from the Fed is basically that they're not going to hike rates at this point. I think the market and the dollar is already priced in that the Fed could very well be on pause. We're baking in 0 to 1 rate cuts for the rest of this year. So again, any positivity towards inflation maybe starting to ease, that could help weaken the dollar and move money into emerging markets, or just the fact the Fed might not hike rates, which I really think is fully off the table. So I'd be looking for the dollar to weaken a little bit. And when we start to see that happen, I'd be wanting to start to diversify a little bit by moving into emerging markets, and one like India that has so significantly decoupled from the rest of the emerging market complex, I think is where some foreign investors will finally start to be looking, just because the valuation is there, and by the central bank cutting, expectations for growth might start to pick up again.
Matt, are you looking at the monetary policy in India as closely as we are? And if we do see a 25 basis point cut, everyone's pricing in a 50 to 75 basis point across this calendar year. How do you see that in the Indian context, weakening rupee like other emerging markets currencies? Is this the boost we need? And what would be your outlook on the market post that as far as India is concerned?
Yeah, Tamana, I think that is a boost that India needs, and it really is from the foreign investor perspective, because FII flows have been just nearly historically weak, at least over the past few years. And so we need to see, outside of domestic investors, we need to see foreign investors start to move money back. And a rate cut, I think, could be the signal of that. In addition to the dollar, it's just the growth scares in India's or slowing growth coupled with valuations that I think threw foreign investors off. And so we're seeing stabilization in the market. And what we've seen through the budget as well is a lot of higher quality companies that have reported strong earnings have done very well. Those who are leaning into farming and agriculture, those who are a little bit more levered to the consumer. I like to own the highest quality businesses there. So for me, if we get what's expected and there's guidance towards perhaps those rate cuts coming to fruition later this year, I want to lean in to some of those trades. And I also want to make sure I'm exposed or increase exposure to financials as well, who are going to be able to finance some more of that growth that might come as expectations start to pick up. So, looking for the highest quality private banks, staying within, your highest quality auto companies, those plays I think continue to work. And that's what I would want to buy on any sort of weakness.
Matt, thanks so much for joining us this morning. Pleasure as always speaking to you. Thanks so much.
Thank you.
All right, that's Matt Orton. And interesting perspective, right? He's speaking about the rate cut as a possible signal for the tide to turn for foreign institutional investors. And that is important because once again in trade yesterday, you saw selling to the extent of 3,550 crore rupees on a net basis by foreign institutional investors, and buying to the extent of about 2,700 crore rupees for domestic institutions.